Welcome, folks, to Credit Banking Mastermind number 21. I'm super excited to be here. Thank you so much to CJ Wallace for allowing us to be here on his YouTube channel. We love being here on the Velocity channel each and every week as we bring to you not only a bit of a training on the strategy of credit banking, but also as we go through a case study and we work this as a mastermind, all trying to work together, learning how to create financial freedom for ourselves. My name is Joseph Smith. Hello, my business partner, Mr. Ronaldo Fleming. Woohoo! Yeehaw! We're so glad to be here tonight with all of you. Special shout out to all of our folks in the webinar itself, our mastermind tonight. Antonio, Fritz, Gabrielle, Jamar, and Raul. We will be leaning upon them as they participate largely in the case study as we work the math and we figure out how in the heck do you do credit banking? So what I need to do is figure out how to share my screen. And that is no simple feat. I don't want that one. I want this one. Okay. All right. And then I go here. Hopefully I'm doing all of this right. And now I've learned that I have to click on that first, right?
Beautiful.
Perfect.
I think so.
Okay, so where did this go? I'm gonna have to do it the way we've done it before in the past, because you've extended my screen. I can't see it. Okay. Sorry, folks, for the technical tip. We're gonna jump right in here as soon as I can, figure out how in the heck do we do this. All right, boom. Now you can see my screen. Now I can start my PowerPoint. All right, starting the PowerPoint. All right, then of course I have to share with you my second screen so you can actually see the PowerPoint. All right, we're here. We made it, folks. Hello and welcome again to Credit Banking Mastermind number 21. Can you believe that? What are we here to study tonight? We're here to study credit banking and the search for the lost American dream. Each and every week, we go over the different facets of the credit banking strategy. We look at budget, and we look at lines of credit, and we look at loans, and we look at the actual credit banking strategy in terms of how to push our income through our lines of credit. We go over all kinds of crazy things, calculating. We do the math on this. We look at debt efficiency. We try to understand the utilization. We're going to be talking a lot about utilization tonight. But before we go any further, I must let you know right off the bat that I'm not a licensed attorney, accountant, financial advisor, broker, or any other licensed individual. And even if I have a license, I'm not acting in that capacity. Therefore, I will not discuss or provide any specific counsel, advice, or instruction that would apply to specific individuals. This presentation tonight is intended to be general information only. Wise Guys and Ties, LLC, that's my company. We recommend that you engage in the services of professionals when making decisions that have a legal impact, especially financial decisions. And what does that mean? You must do your own due diligence. All right. Who are we? My name's Joseph Smith. This is Mr. Ray Fleming.
Risky Ray.
Risky Ray Fleming. I'm known as the money guy. This is the property guy. We've come together and we formed the Wise Guys and Ties. Wise in the ways of helping you build business credit, but also wise in the ways of helping you implement credit banking strategies so you can eliminate your debt in 1/3 the time. Our contact information is right there on the screen. Today, what are we talking about today? Over the last 4 or 5 weeks, we just finished going through the whole teaching. Like if it had been a training, like we were one of our live seminars, we would have just finished a 4 or 5 hour training. Right. We've just gone through all of how to do credit banking. So here we are. We're kind of getting started again. But before we, each and every week, we're going to break this down, hopefully into bite-sized morsels. But we really need to talk about credit and credit score. And how in the heck does that fit into everything? I mean, it seems like credit score is the most important thing in the entire world. I mean, it's more important than even what your mom thinks of you, right?
Absolutely. I mean, it can affect interest rates. I mean, there's people that could actually lose jobs over their credit score.
Absolutely. So what's a good credit score? Let me ask you that question.
Well, I'm going to give my generic safe response as always. It depends.
Really?
Depends on, what scoring model. I mean, there's a lot of different factors. It depends. It depends on, frankly, what day of the week it is, who I'm pulling it from. I mean, there's a whole lot of different factors. What I'm pulling it for.
Well, okay, let me ask it to you this way. Is it possible to have, say, a score of 780 and still not get approved for a loan?
Absolutely.
Is it possible to have a score as low as, say, 590 and get approved for a loan?
Yes.
So what the heck? What the heck? So what is the big deal about credit score? It seems to run our lives, but yet it seems to make no sense. I mean, because it's one of many factors that are looked at, and so
it's the easiest way to open the door.
That's what I was going to say. So thanks for bringing that up. See, credit score you don't get necessarily approved for any type of loan or line of credit based off of your credit score. Credit score is it's like going into that place where, like at Vegas, back when they used to gamble there.
Mm-hmm. Right.
But you know how you have to go on the high stakes table, you have to have the chips to even play there, right? So your credit score gets you into consideration for approval, into the approval process. You know what I mean?
Yeah.
Okay. So, but let's look at it. So here we are. We're trying to fend for our lives. This presentation kind of has a whole Indiana Jones theme as we're like running through the jungles, trying to avoid the natives, which are our creditors. And so when it comes to credit score, where do you check your credit score? You're swinging by. What are the different scoring models? This is typically where people go to check their credit score. Have you heard of Credit Karma or Credit Sesame, Credit.com, Credit Check Total? You've got the Equifax scoring model. If you look very carefully, you can see the scoring ranges of those models. So the Equifax one, 280 to 850, but the Experian Plus score, which is Credit Check Total, is 330 to 830. The national equivalency score, right, is 360 to 840. And then the trans risk score or Credit Karma is 300 to 850.
Ooh.
There's a lot of things there. So people, they check their credit score and then they look at it and then they go and they get some statement maybe from their bank, or they go to the car dealership because they're looking to buy a car and they say, oh, my score went up, or oh man, my score went down.
Right.
But did it ever really go up or down?
No, not really.
No. Your credit score is based off of your credit profile, and the information. The information doesn't really. There's a lot that we're going to talk about, the factors that go into determining your score. But when your credit score is pulled, which credit score are we talking about? I mean, because here, this is what you see. This is typically where people go and check these models, but there's more scoring models out there. What are the lenders looking at? Well, your credit optics score, the lender application score, the Experian Score X Plus, the Vantage credit score. Actually, I think the Vantage credit score should be on the previous slide, and I kind of got those mixed up. And then I think that the national equivalency score. So I'll have to fix my slide. But the national equivalency score is actually what the lenders look at. Anyway, the point is there's so many different models out there, and on top of that, they each have different weights to them.
So you're telling me that the lenders pull a different scoring model than maybe what I could check myself?
Correct, because first of all, are we talking about the FICO 7 model? There's a FICO 4 model. There's a FICO 8, a FICO 9, right? There's Vantage 1.0, Vantage 2.0, Vantage 3.0, right? There's all these different models. So Vantage is supposed to be a compilation of the three major scores. But while you can look at that and it looks great and everything, most lenders don't even look at that. So here you are looking at these wonderful scores online at all these people encouraging you to check your score. You could go directly to the bureaus, Equifax, TransUnion, and pull your credit score. But whatever score they're pulling, right? It's not what the lenders are pulling. The lenders, they pay for information to be weighted for them. So if you're going to get a mortgage, you're going to get a mortgage weighted score. And what does that mean? So let's say you're somebody who you never miss a house payment. I mean, the rent payment, the house payment, we don't miss that for anything. But maybe occasionally we have a 30-day late on an auto bill or a credit card, but we never miss the rent, right? The rent payment or the lease payment, or the mortgage payment. Well, in a mortgage weighted model, they're going to score those 30-day lates on like credit card and car payments much less, right? And the fact that you never miss a payment, that's going to be scored heavier. So you'll get a higher score in that model than if we took those same numbers and ran it through an auto-weighted model where we see, wow, you've missed several auto payments, or you're late. You haven't you make your payments, but you seem to be always running 30 days behind, right? So to them, they don't care that you made your mortgage payment every single month. They're looking at the fact that you're missing these auto payments. So in their weighted model, when you check your score with them, your score now comes up lower. In fact, I was reading just the other day that right now there are somewhere around 500 different weighted FICO models.
Wow.
500.
Wow.
That the lenders are looking at. So you go to Credit Karma, Credit Sesame or something, your score is never going to match what the bank pulls for a loan, what the auto dealership. I mean, if you're going online and trying to check for a credit card, what is your credit score? I mean, who knows, right? So what are so this is just one of the things that just drives people crazy. So people say, well, what do I need to do to have a good credit score? Well, I guess it depends on what are you trying to do with that credit score, right? If you're trying to get a loan for a house, right, we need to look at that differently than are we trying to get a loan for a car? Are we trying to get approved for a home equity line of credit, right? There's different ways to look at your credit score. So what are the factors? Well, let's take a look at two of the most popular models that are used out there. Vantage 3.0. Now, this is typically the model that people see. That's what's out in the public domain. You're going and you're checking your credit scores online somewhere. You're usually coming back with this model, but the FICO 8 model might be, and it's going to be weighted to some degree. So each of these broad categories that we're going to talk about have subcategories that change the weight of the score. So if we're looking at Vantage 3.0, you're going to see that there are 6 factors. Your payment history, I mean, that's the biggest part. Are you making paying all your bills on time, right? They're looking at back in the past history. Do you have foreclosures, bankruptcies? Have you been sent to collections, right? All of those are different subsets into the payment history. And depending on certain models, that they either count or don't count that. Sometimes when you get sent to collections, there are some models like the FICO 9 that if it's medical collections, they weight it differently or lighter than they do retail collections.
That's important because there's a lot of those medical bills that drag people down.
Absolutely. And also in the FICO 9 model, which we're not talking about here, but the FICO 9, when you pay off collections, it then weights it differently. So they're giving you credit for paying that off. Now, a lot of reasons why lenders don't like the FICO 9 model is because it's so borrower friendly, right? It's not protecting us as the lender and our investors as much because you're taking people that actually are higher risk. Even though they've mitigated some of that risk, they still have a history of being a risk. Ooh. So that's why they stay with some of their models that they have. So when we're looking at it, payment history is huge. Then the next largest point or portion is your credit utilization. How indebted are you? How much debt do you have? How much debt are you carrying on your lines of credit? That's really what utilization is. So if they have extended to you $1,000 in a line of credit and you're carrying, here, this question for you, Ray. If you have $1,000 limit and you have $1,000 balance, calculate for me what your utilization is.
Would be pretty close to 100% utilization.
That's right. We have some people commenting on in our chat screen. So we have, yes, Raul, he's right on it. You know, I really think he just sits there with the calculator.
Yep.
Good job, Raul. All right, so Raul, if you have a $25,000 credit limit, but you're carrying a $14,000 balance, what's your utilization? Come on, clock's ticking. Clock's ticking, Raul. What is it? Come on, $25,000 limit, $14,000 balance. I'm waiting. 56% utilization. Perfect.
Beautiful.
Can you really count on that guy?
I barely could get my calculator up.
So this is how utilization is looked at. And so it really breaks into three ways. There's three ways that lenders look at your utilization. If you are between 0 to 30%, they're like, yay, you are awesome. If you're between 31% to 50%, they're like, meh. Right? Like, it's not good, it's not bad, it's just sort of meh. And then if you're at 51% to 100%, it's like, boo, we don't want to give you any money.
Start taking money away from you.
Right? So this is definitely things that you need to understand. So if you had that $25,000 balance and you are carrying a $25,000 limit, but you're carrying a $14,000 balance, you're at 56% utilization. And you might feel like, well, I'm not using the whole line, but you are in the boo category and you've got to get at least into the meh category so that it's not bad. And you should be working towards staying into the good category so that you get a little check mark in your utilization box whenever they're trying to calculate you for a credit limit increase, an interest rate reduction, or if you're applying for new lines of credit, you want to keep that utilization under control. So then after that, we begin to look at what the credit balances are that you have. So your credit balances, this is really looking at your age of accounts. Okay. You have a whole bunch of different credit that's out there. Are you into a mortgage, auto loan? Do you have credit cards? What are the balances? How have you been doing with all of that? See, the more that you can handle, the more that you can multitask financially, it shows that you are responsible. Also, another factor that they look at with your credit balances is the more or a greater mix that you have, the more stable you are. Because if you have two different people that you could lend to, one person has a credit card or two, and another person has a home mortgage, has 2 auto loans, has 3 credit cards, which person is more likely to just walk away from their debt if they get in trouble? The two credit card person,
credit cards,
or the person with the house and the 2 autos and the 3 credit cards?
And I just like the fact that they've been able to manage multiple different products that the bank has extended.
Exactly. So again, the key to all of these models is managing risk. And so if you look at your score and how it breaks down to the bank trying to assess how much money are they going to make. I mean, your credit score is simply the likelihood in the next 90 days of you defaulting. Right? That's all it is. It's not a likelihood of you getting approved. It's not a likelihood of you going into foreclosure or bankruptcy. It's just in the next 90 days, what is the likelihood of you defaulting on any of your financial obligations? That's all your credit score really is a picture of. So when we look at the next category, though, we're going into your depth of credit. Again, your depth of credit, that's you know what, I kind of got a little mixed up here. That's actually your mix of accounts. So you have to forgive me. What your the credit balances that they're talking about is the ratios. I'm sorry, between. So okay, when you're looking at utilization, there's an overall utilization, and then there's your utilization per each individual card.
Right.
Right. So you could have several accounts that you're not using all, but you've loaded up this one.
Okay. Yes.
Right. So, but then you get a score that reflects an overall utilization over all your lines of credit. But you need to also lenders are tracking your individual credit balances and where you're at. So also we're looking at recent credit, which is your inquiries. Okay. So inquiries, what that is it's looking at volume over time. That's really what it is. How often are you checking your credit over a specific period of time? So the more you check your credit in a short period of time, then it begins to raise eyebrows.
Right, because then it could signal somebody's in need of money.
Right. Well,
financial need.
You can qualify for these loans, but in these inquiries, what they just tell you is that you asked for a new account. It gives nobody the information of did you get approved or declined for that account and why. So if you go out and you're looking for money, and let's say I'm the fifth lender that you've come to, and I see 4 other inquiries, I have to assume that one of 2 things. You either got approved for 4 different lines, and I'm going to be the 5th lender, right? So, I'm taking that kind of risk. Or you got denied for 4 lines of credit. And I'm thinking about maybe giving you a line of credit, but now I'm wondering, what do those 4 know that I don't know, right?
Exactly.
So when you have a lot of inquiries in a short period of time, it can, it has an impact to your score. Of course, but really your inquiries play more a role in actually whether or not you get approved, right? So your score gets your foot in the door, but a lot of times your credit utilization and your recent inquiries are what play the largest factor in approval. No, on the credit side, we've got income to debt ratio, which has nothing to do with credit. Did you know that, by the way?
Yeah.
A lot of people think that your income to debt ratio affects your credit score. It's not true.
DTI.
So your DTI is a separate way that the bank tries to see if you can qualify for a loan or a line of credit. Your credit score on your report gets you your foot in the door. The things in your credit report, if you have a recent bankruptcy, well, that's going to potentially disqualify you. You can have everything right here, but what if you've got a great credit score, you've got great utilization, low inquiries, we're looking at your income to debt ratio is low, but then when we go to verify your income, we've got no job. Well, does it matter how great my credit score is, how great my profile is, how great my debt to income ratio is, if I have no verifiable income?
No way to pay those bills.
So people tend to put too much stock into the credit score. It's important to understand these factors that affect your credit score. Again, we're looking at, and then 7% on the Vantage model is your available credit, meaning some people, they have a whole bunch of 500 limit credit cards, right? And so when you look at utilization, you see a percentage, you see low balances, those all might be good. But then when you see available limit is only, say, 500, well, that's going to get scored lower than somebody who has a $10,000 or $15,000 or $20,000 line, and then they're still keeping low balances. Then that's going to be weighted higher. Now, that's the Vantage 3.0 model. And the FICO model, very similar, but weighted differently because only 5 factors, because they don't really look at the credit balance, and then the credit balances and the utilization are kind of all combined into one. So what we're looking at here is, and you see the differences even on the model on your screen. But even what you're looking at here, when the lender looks at it, they might weight the payment history even more, the utilization less, or the utilization might be weighted more, and they don't really weight the mix of accounts or maybe the age of accounts as important in their weighted models. And so that's why you show up and sometimes somebody, you thought, well, you know, I went online and I saw I have about a 650, and then some bank checks your score and they're like, yeah, you got a 700. You're like, whoa, my score just went up. No, they're looking at a weighted model, and it's based off of what you're applying for. So the reason why we're going over this is because you really need to understand how credit score plays into this. It's really just your ticket to get your foot in the door, to just even be considered for approval. But so what are different choices that we can make? Well, we know now for utilization that we really should keep 30% utilization or less. We understand that we should always be paying our bills on time, minimizing late payments and things like that. But something with age of accounts. The number one thing that hurts age of accounts, which you know, it's a large part of your score. 15% of your score is just your age of accounts. But every time you close an account, you've lowered your age of account. And conversely, every time you open a new account, you've now shortened that average. So just keeping that in mind, you are going to open new accounts, but that sometimes people wonder, man, I just saw they get the report, they run it again, and they notice that there's a change in the score, meaning you've checked the exact same scoring model. When you check your score along with different places, you're always going to get a different number, right? But if you have if there's an update in the same data and you're checking the exact same scoring model, then you will notice a change in the score. Largely, if you just opened a new account, well, but here's another thing that happens. And we see this all the time. Somebody who can qualify for, say, $100,000 in lines of credit, but they only need 20, so they only ask for 20.
Ooh.
Can you explain what happens there on the utilization?
Well, you just simply can't use the $20,000. If we're looking at the personal side, you have to maintain. If you want to maintain your credit score, your credit profile, then you're going to want to be aware of that utilization. That's why we talk a lot about business credit, because if you are going to be doing anything where you need access to that much capital, then you might as well be using it through a business in a sense, because utilization doesn't become a factor if done right.
So if we have two people, they both, let's say you and me, we both can qualify personally for $100,000.
Right.
You go for all of it, right? You're going to go, and I only need 20,000, so I'm only going to go for 20. All right. You only needed 20 as well.
Right.
So you spend your 20,
mm-hmm.
I spend my 20, and then I realize, you know what, I need a little bit more money.
Ooh, okay.
What happens when I go back, because I qualified for 100, I should be able to go back and get some more.
No, you won't be able to get any more. And you got to also be cautious about those ones that you did use.
I got a $20,000 line of credit and I just maxed it out, and I got it.
You aren't going to get any more funds for sure. And then you run the risk of actually when you drop that, getting dropped as well.
I put $20,000 on this card and I'm making the payment. 6 months later, I can't go back and get any more money.
It depends. Wait, do you still have a balance on there?
Yeah, it's like at 19.6 or something.
I wouldn't approve you.
Now, same thing with you. You did the exact same thing. You went out, you qualified for 100, you went and got 100, you spent 20, you've been making all your payments for 6 months. You realize that you need to get some more credit. What happens when you go and apply for more credit? Are you going to get it?
Absolutely. Well, it depends.
Well, you've been making all your payments. You're at 20% utilization.
Yeah. For the most part, you should. You should. And it depends on each individual person, because then there is always that personal cap. You'll only get extended so much as a person.
That's true.
But for the most part, I would lend to you, because it looks like you've been able to manage your.
And so with utilization, that's what throws so many people off. They have the ability to get a lot, but it kind of scares them, so they pull back. They just get what they think they need, and now they're actually hurting.
Right.
Because you should always try to get as much as you can get whenever you apply, and that way, because you want to have more than what you actually need, so that you don't throw off your utilization. But inquiries, a lot of people are really concerned about inquiries. And I would say it does have an important concern if you are using a lot of them in a very short period of time. But let's say every 3 months you have an inquiry because maybe you called the card, a different card, and you're asking for a credit limit increase or an interest rate reduction. That's going to have such a minor impact. When it comes to inquiries, they really only affect the calculation of your score for 1 year. Right? They'll stay on your report for up to 2 years. But these are things that we all need to consider. And so that's why we're talking about it here today, because we talk so much about credit banking, velocity banking, mortgage sweep strategies, cash flow banking, infinity banking, all of these different these credit banking strategies. But for some people, if you don't even understand how credit itself works, then when people jump in and they start using these strategies, and then they throw their utilization out of control, or you miss a payment along the way of doing there's so many different ways where if you don't even understand credit or how it works, you can hurt yourself. And that's why we want to make sure that we're raising the bar of your knowledge, especially about credit. And a lot of people don't realize how they can positively impact their credit by, let's say you do have some extra cards, like you have that one card that you keep for emergencies. So I don't have anything on it, but it's got a high limit, right? But then I use this other card and it's maxed out, right? And it's high limits all the time. What I need to do is see my credit cards, they run on a couple of principles. First of all, if you don't use it, you lose it, right? You might be thinking you've got this emergency credit card account that's got $10, $15, $20,000 on it, but you haven't used it in a couple of years. The bank is shrinking down your limit, and they sent you notification in an email that you thought was spam, you deleted, you don't even know. An emergency comes and you go and you think you've got $20,000 on this card and it's declined, and you find out your limit's only $5,000. You're like, what? Well, if you don't use it, you lose it. And then another aspect is credit and building your credit. It can only help you if you're using your card. So it's very important to use your credit responsibly, right? And so if I have 2 cards, one card over here has this great big limit, but I was saving it for in case of emergency, and I really just use this card over here all the time, well, I'm actually out of my utilization overall might look good, but because this one card is out of control, I actually can't qualify for new credit, and it's affecting my credit score negatively. So I need to take this card and transfer some of the balance over and bring all of my cards into this proper balance of between 0 to 30% utilization. And so for a lot of folks, there's this, and then some people say, well, there's an extra fee for this transfer. And it's just like, pay a fee so that you go from not getting approved for your HELOC to getting approved for the best HELOC possible. You know what I'm saying? Like, don't let fees that the bank or credit cards charge deter you from doing what's in your best interest for your credit, which is also why we have disclaimers. Everybody, we try to educate you so that you can make informed decisions. That's bottom line what we want you to do. And when it comes to credit, there's a lot of things that people can do that actually can increase their credit score that they just don't realize. Most people think that your credit is just your payment history, right? They only, like if I miss a payment, obviously my credit score goes down, but if I make my payments, then it goes up.
Before I even looked into it, that's the way I thought it worked. I didn't know any of these other factors played a role. And actually before this, I had a big credit card, but then for budgeting purposes, I'm like, I'm only going to stick with my $500 credit card. That way I don't overspend and not use my $5,000 credit card. But every month I'm basically running a maxed out limit on my 500 for budgeting. But in reality, when it made sense to me, the truth was I was lying to myself, or I just simply didn't know.
Mm-hmm. Absolutely. Now, your credit score factors into a lot of things, because sometimes people just look at your credit score to see if they'll approve you to live at that apartment complex. I mean, credit score plays people check credit scores for a lot. I mean, do you and I check credit scores of people before we set up seller finance notes?
Yes, absolutely.
So, I mean, it plays such a huge factor. And then if you have a seller finance note, right? Did you check the credit score? You can't. Your seller finance note is something that's that you can actually sell. But if you don't have a credit score that you checked on the person who's making the payments, you can't sell it.
Mm.
I mean, there's so many things. I mean, I'm just listing off a couple of things, but you need a credit score for so many things that it doesn't even make sense. I mean, some job applications, are they going to check your credit before they give you a job there?
They will. Buying a cell phone.
So some people can be watching some other guy on YouTube tell them to cut up their credit cards, and then they can tank their credit by closing all those accounts, right? That could be a huge impact. And even though you might not intend to use any credit, your credit score affects your ability to go live somewhere or get a job or sell other assets that you have. So, I mean, we need to understand and make smart choices about what we do with our credit. And some people, they're like, well, I'm not ever going to have an auto loan, right? I want to buy my cars outright. But if your credit profile had an auto loan on it, it might mean the difference between getting 70% loan to value on a HELOC or getting 85%. Mm. I mean, you never know. I mean, there's so many, if you had a greater mix in your accounts. So I'm hoping that as you are following along, as we talk about your credit score, that you're really learning a lot, because these are the things that can really help you as you're trying to implement a credit banking strategy. Now, if you're trying to build your credit, right? How are we going to build our credit? Are we going to have be an authorized signer on somebody else's card?
That's one way.
We could apply for some of those high interest rate accounts like they give to like college students, but you get a $500 limit, but it's at a high interest rate. A secured credit card, if you have bad credit and you're trying to repair it. I mean, there's so many different ways. Somebody can co-sign, the ability to co-sign. So there's a lot of ways, but the number one thing that hurts people is trying to build credit too fast. If you apply to too many accounts, open too many credit cards. So you want to open an account and then you want to grow it. You want to use it. And then every 6 to 12 months, you want to see if you can get a credit limit increase, right? Because if you open up a $500 limit credit card, and then next month you apply for another one, what's that limit going to be on the second card? Your first card's 500. What's the next card going to be?
1,000.
Probably more like 500, right?
Well, right.
I'm just saying a month later.
Oh, a month later. Yeah.
Right.
Sorry, I was thinking 6. Yeah.
So, but if I'm trying to build my credit too fast and I open up all these $500 credit cards, now let's say I've been using them for a year, and I go to open a fourth credit card. They're looking at all these $500 credit cards.
Yeah, you're looking like at 5,000 now.
So, but what you want to do is, if all you have, or if a lender looks and they see that everybody who's taken a chance on you only gave you 500, well, that's all they want to give you. What you need to do is you need to work inside those accounts and grow them. So you want to show that your limits have grown, that you now have a $1,000 limit, of $1,500, $2,000. So, and you can do that about every 6 months. You should be calling on your cards. If you do that, though, be advised that could lead to a hard inquiry, right?
Right.
So if you have, let's say, 4 cards and you call all 4 cards on the same month, you've got 4 inquiries, that's, so we want to be smart about how we do this. We want to be credit smart. So we're going to call on that. But once we get the credit line to grow, then we can go apply to another card. And then if I've had this card for 6 months or 12 months or even 18 months, and now I'm at a $3,000 limit, now my next card on the personal side should match what I have, right? So now I get another $3,000 card, and then I work to build that one up, and so now that one, maybe I get that up to 6,000, and then I apply for my third card, and then they're going to look at the fact that I have a 3,000, a 6,000, so maybe they're going to give me a 5 or a 6 or even a $7,000 card. So I begin to grow my credits. But how long does it take? Well, to build good credit score, it takes time. There's no fast way to do this. There's no shortcut. And there are people that sell you on shortcuts all the time, but they're really not. So
if you've had any major issues, I mean, it's going to take 5, 7, 10 years. Maybe.
Issues, you mean like I have a negative on my report?
Some real negative issues, maybe a bankruptcy or foreclosure.
So that's like credit repair, right? And credit repair is how we dispute those errors or maybe inaccuracies. But how do we get those things off of our credit that have been there? Well, that takes time too.
Mm-hmm.
I've used a credit repair company. I don't know if you have.
I have not.
I used a credit repair company. It took like 18 months, and they were able to remove about 4 things off of my credit. It was good, but it was still a lot of time. It took 18 months. So I mean, there's no fast way, right, to do this. And this is what usually leads us into talking about credit banking, because credit banking is a great strategy that I think accelerate. I mean, credit repair, in terms of getting negatives off your report, credit banking isn't going to get any negatives off your report. But what it's going to do is it's going to help you move your money. And that movement of money creates, you can have, okay, so here you have your bank account and you need to pay your cell phone bill. So what you do is you take your credit card and you pay the cell phone bill. Then you move money from your checking account and you pay the credit card bill. I mean, that seems like, oh yeah, okay, that happens. But you've had one actual payment, but it created 2 payment transactions. There was the payment transaction that was created between the credit card and the cell phone bill, but then there was you paying off the credit card company. And so the way a lot of people move things is, so what if you have a line of credit, a personal line of credit, or you have a home equity line of credit? You still have the cell phone bill over here. So you have a credit card, pay the cell phone bill, then you have the line of credit, pay off the credit card, then you have the checking account, pay off the line of credit. And so one actual payment turned into 3 payment transactions. And so when you start using a credit banking strategy, you immediately increase your payment history. I mean, it explodes. Like they start looking at how your payment history used to be, and then all of a sudden now it's 3 times, 4 times what it used to be. All of that, keep in mind that we're talking about complex algorithms that are computing everything, but if you are flooding the zone with so much positive payment history, it is just mathematically going to minimize the negatives that are on there. It just has to. And so credit banking as a strategy itself, by itself, ends up increasing people's credit score because of the positive, because every model really weights payment history heavy. So the more we put a whole bunch of payment history in there, negatives become smaller. They're still negative, they're still there, but because there's so much positive payment history, we're like trying to overwhelm it. We're flooding. We're going to drown that negative and all this positivity that we got going on. So the credit banking strategy that we use is our pathway to get to our financial dream. So for a lot of people, they're swimming in debt, and we get that. You got so much debt that your dream is to just one day just be debt free. And for those of you that I'm speaking like directly to you right now, what you see on your screen is the treasure map. This is what gets us there. And It was torn up. It was broken a long time ago because we bought into consumerism, materialism, and we bought into an American dream that was sold to us that turned into the American nightmare because we were told that we had to go to school to get a good job, but before we could get that job, we had to go to college to get the degree. And then we got the job, and then we get the house and the 2 cars and the wife and the kids. And before you know it, you're $500,000 in debt or more. And you have a job that can't even service that debt. And you're literally broke at a higher level. You went through all of this. And so many people end up being stuck. You know what I'm talking about?
I know what you're talking about.
And so along that way, this credit banking, this map, it was lost. So it was found, and now we have to put it all together. And so over the next few weeks, next week, we're going to talk about budget right there in the middle of your screen. And the important thing that we learn about budget is how to create positive cash flow with our budget, positive cash flow. So we look at our income and our expenses. Really, that's what a budget is. It's your income minus your expenses. When you talk to almost every financial planner, but people out there that are going to help you with your budget, what are they going to do? They're going to help you look at your expenses and try to cut back. And there's nothing wrong with that, especially if we're heavy into consumerism and we're spending money like crazy, right? That's a good place to start. But what I feel like gets neglected is the ability to increase your income. And we talk and we try to, each time we go over budget, talk about ways that you can increase your income. There are a number of ways to do this. And so increasing your income, and when we look at expenses, before we just start completely cutting back on everything, where can we find duplication? There's so much duplication in our lives because we've set everything on auto pay, right? We just don't even know how many things we're paying for more than once. Sometimes we've helped people free up anywhere from an extra $100 a month to, in some cases, it was like $1,500 in just duplications. And so, but we go over budget and we have to learn how to create positive cash flow because that's really going to be the fuel that propels us through this whole process. Then the following week after that, we're really going to get into the math. There's a lot of math. You got to get out your calculators, right? Your abacuses for those who don't believe in calculators. Your slide rules. You remember the slide rule?
Yeah.
Did you ever have a slide rule?
I never really knew how to work it too well.
Those things. Can you believe that was the technology that the rocket scientists from NASA used to put a man on the moon?
Man,
They didn't have calculators. They were using their little slide rules.
It's amazing.
So what we're going to do is we're going to look at how is interest calculated on lines of credit and how is the interest calculated on a loan, and help us identify where things are really costing us the most, and help us see the tools. The bank provides us with these tools, right? We're going to use these tools that the bank gives us and look how can we use these synergistically to pay these off faster. Because too many times what we do is we keep them separated, and we use that thought, well, I got my rainy day fund or just in case of emergency. And we have these tools that we've been given by the bank that could really be used in concert with one another to greatly reduce our debt. And so once we understand how they work and how they can work together, and we do that by studying the math behind it, then we're ready to actually move into the third phase, which is where we actually talk about credit banking. See, for like 2 weeks, even this week, we're not really talking about credit banking, which is the process of taking your actual lines of credit or your credit cards and turning them into your bank account and pushing all of your income, all of your expenses through your line of credit. But how do you do that? How do you pay a mortgage with a credit card? How do you make an auto payment with a credit card? What about the mortgage interest rate deduction? And what about emergencies? When you stop using your savings account or even your long-term savings, like your 401k, we get a lot of questions like, well, if I'm not putting money there and I'm doing this, they feel like they're losing money, or they're not prepared for um, uh, life's inevitable. Um, what do you want to call that? Act of God,
Right.
that might
Circumstances, situation.
right? Act of man sometimes. But so what we do with credit banking is we show the strategy, how it works, and how it accounts for all of the different questions that come up with, well, what about this? Or what if this? Or what about this? And so the credit banking strategy, when you understand the budget and the lines versus loans, makes credit banking so much easier. So if we have a good knowledge of how to create cash flow, and we understand the difference between lines and loans and how to use them in concert with one another, then the credit banking strategy is actually quite simple at that point. And so this is what we do. We just begin to move everything around, right? And we create our map, and we get everything lined up where it's supposed to be, and we put the map together. And this is why people come here each and every week, is to learn how to do this credit banking strategy. So next week, we're going to get into everyone's favorite subject, the B word, budget, right? But now we're going to get to the case study. But before that, I think, Ray, you have some stuff you want to share about the big picture of everything.
Here, I'll just click it.
Are you sure?
Yeah. No,
I can click it for you.
That way we'll just roll through it. Yeah. That'll work. Hey, cool. We got some really exciting stuff for you, because we wanted to show you, how does credit banking really fit into everything that we do? Why is this such an important factor in our business and our daily life and just everything that we do? It's a very powerful tool. And as you've been watching these trainings, as you've come across this, this strategy, and I know a lot of you on here have had tremendous success, and I love hearing all of your stories about, oh, wow, I got my car paid off in 18 months. It was a 6-year loan. Oh, I'm 2 years away from getting my house paid off, and I've only owned it for 4 years. This is some real serious, powerful stuff. And I think there's a lot of people that are skeptical, but it is at the core one of the very deep foundations of wealth and building wealth. So where does this fit into the big picture of everything? Well, the systems that we deal with in America, the tax system, the banking system, the business system, the real estate system, these are what we call the pillars of wealth, because every single penny in the US economy flows through these pillars. And so the banking is really to understand how to play in the world of banking, how to play the game that the bank is playing, how to not get taken advantage of. Because the truth is, if you don't understand and you don't understand the principles, it's very easy to be taken advantage of or pay too much. Same with taxes, business, and real estate. If you don't understand those, it's very easy to be taken advantage of. And so let's just talk real quick about business. Now, I just want to lay this out so you understand how everything flows together. Wise Guys and Ties LLC is a business. For example, if we wanted to purchase a vehicle, which we have, so we spend $15,000 on a truck. And then what we end up doing with that truck is one of our other companies, J-Team Company, needs a truck. So how can both businesses benefit from one truck purchase? Well, what we do is the main company purchases the truck, but then it leases the truck to the secondary business.
So in business, you've just created a stream of income off of that lease.
Absolutely. We're starting to create, yes, we're turning it into an asset where it's starting to produce funds.
And the truck is used to help J-Team produce $40,000 in marketing.
Exactly. And it costs J-Team's expense, and their lease payment is $200 a month. Now, what does this do? We have one business that leased their vehicle to another business, so that business can go make money. But then you look at J-Team and you're like, well, J-Team has this expense. They got this $200 a month lease. They have insurance they have to pay for. They have to pay for gas. They have to pay for maintenance. And that's $633 a month on average that J-Team has to come out of that business pocket to pay for that truck. But what is the benefit to J-Team? Let's take a look at this. On the tax side, what J-Team can then do is it can write off their business mileage 20,000 miles a year, if we take what the federal government, the IRS, allows you to write off and deduct a certain amount of money per mile you drive, 58 cents. If we multiply that, that equates to an $11,600 yearly deduction on earned money.
That's like money back from the government.
Absolutely, that is money back. So, I mean, if we're talking, I mean, some people talk about their mortgage deduction, and we're talking about really expanding the amount of deductions that you can gain access to. Now, there's two different options. I mean, there's itemizing everything, or we just take the mileage deduction. In this case, we're going to take the mileage deduction. And let's add up those expenses. So if we add $633 and we multiply that by 12 months, that gives us $7,600 that we've spent on that truck. But when we take the mileage deduction, that leaves us an extra, $4,000 of extra write-offs. So we've now covered all of our expenses where we do not have to pay taxes on any of that money that we spent on the truck or that J-Team spent on that truck. But now there's an extra $4,000 of deductions that could be put towards, profit that was made elsewhere. That's literally like, if we look at this, we divide that by 12. That's like the government's paying you $333 a month just to set it up this way.
Right. So the money that came in paid for the lease and the insurance and the gas and the maintenance, right, that you use for your business. And then on top of that, like you said, getting paid from the government. It's like, so is it really costing J-Team $200 a month?
Absolutely not. No, it really isn't. And then where does this fit into the big scheme of things? If you look over to the real estate side, now real estate is another business that we're in, so we're looking at rental properties with cash flow. The truck is needed to check up on rental properties. Mm-hmm. And then so with the rental properties, when those bring in, say, $1,500 a month, over the course of 12 months, we have to use that truck to check up on those.
We could have easily paid for the truck through the cash flow of the, say, 10 months of cash flow, could have paid for the truck that way.
Very well. And there's also not just the rentals, but there's fix and flips, there's wholesales. We aren't diving into too much real estate today, but we will be diving into real estate on Thursday. So make sure you tune in for that real estate and mastermind. Now, between all that, can bring in or brought in around 58
fix and flips and our wholesales for last year.
Right. This is business. And so after all the business, wheeling doings, what's put out is $58,000. Now we also
add in the cash flow from the rentals.
That gives
us 12. The cash flow from the truck.
Right. So then we're adding in all of these items that start to add up all the profitability from all the different aspects of all the business. And then all of a sudden now we're starting to compile a pretty good stack of cash from what these companies are actually starting to make. And then that's how you start to offset the money that you're making. Is the $15,000 deduction? That's a deduction right there for the Wise Guys and Ties company.
Oh, you mean like the truck?
The truck, for $15,000. You can depreciate that over time, or you can take, depending on the size of the truck, you can take it all up pretty much the first year. It just depends on what the tax strategy is. But then J-Team also has the tax strategy and advantage. Then the real estate businesses also have the tax advantages.
Can I point something out? As I look at these four systems of wealth that you're talking about, in the tax, we talk about credit banking all the time. And think about all the money that we save and interest and all that. I mean, if you look, all four of these pillars by themselves could have paid for the truck. Right. You're with these little arrows going everywhere, showing how there's synergy between using these in concert with one another.
Absolutely. And so what's important is what we want to start to do for you folks over the next few months is really build this big picture. It's not just credit banking. It's how do you bring in extra income through business ownership, through real estate investing, and then also about leveraging the tax code. How do you put all of this in place to really build that big picture? And what we're going to be using to really help all of you understand this is what's called Renatus. It's Latin for rebirth. And so what Renatus is going to help you understand is how to keep your wealth through establishing the foundational aspects, but then also how to build your wealth and how to keep it.
So those first two pillars, learning the tax system and learning about credit banking, helps us hold on to the money that we already have.
Right.
And then learning about how to start a business and invest in real estate helps us to build our wealth.
Absolutely. This is what it's all about. Now, that's where Joseph and I met. We met through Renatus, and we had spent, a significant amount on our education, and that's what we are.
But was it worth it? Was $25,000 worth it?
I would do it all day, every day again. I mean, it was totally worth it. It was something that actually was a worthwhile investment. I've spent a lot of money on a lot of things in my life, but that was the only thing that's actually paid dividends.
I think for other people, if you could go back, I think for other people.
Can I go back? Oops.
Oh, here, just bring back over here.
There you go.
I think for other people to consider, is that worth it to them, that $25,000? Is that worth it to you? I want to encourage you to come on Thursday nights, because this is where we actually have a real estate investing mastermind. We also put out on the Wise Guys and Ties channel Tuesdays and Thursdays at lunchtime, all kinds of information on business and taxes. So we really put a lot of information out there for you to fully get an idea of how all of this fits together. But to see the real estate component and how you tie all of these things together on Thursday nights, I want to encourage people, if you haven't already registered, to come on out there. And if you want to learn more about what is this Renatus stuff, we're going to put a link in the description so people can go and find out more. Right?
Absolutely.
Perfect. All right. Well, guess what it's time for?
The case study.
Oh, this is best time of the week, where we get to pull out the cobwebs and we get to actually work on what we just talked about academically. The budget, the lines of credit, the credit banking, how does all of it fit together? Well, this is what we're going to do right now. So what I got to do is I've got to go to a whole nother screen.
A whole new screen.
Okay, so now, here we are. Now I just have to share the screen with you, if I can.
This is my favorite part of the entire mastermind, because it really, each situation is so unique, and I just know that there's so many folks out there that were wondering about, oh, what do I do in this situation, and what do I do in this one? And Snarky says, yeah, I don't have 25,000. That's okay. Do you think it?
Man, we spend all our time showing people.
Okay, we show you guys how to get 50,000. Tune into the business credit training, where we will show you how to get $50,000 in business lines of credit without using your own personal credit.
Well, I want to point one thing out before we get into this case study. I paid for that education. I didn't have 25,000.
I didn't have 25,000.
I've paid for business credit, and I didn't have. When I paid for business credit, I paid.
I think we need to point out a good point.
7,000.
I don't like using my money for anything. To date, this is what's exciting too. To date, I have only spent $10 of my own money in all the real estate that we've ever done. Even the house that I live in right now. That's something for you to think about. I don't like using I like opium, not the drug, other people's money. I love it. I use it, and it's a benefit to everybody. So we help them grow it. But that's something else we'll talk about on, about that on Thursday.
But I mean, first of all, if you are somebody that gets caught up in the cost of things, that's something we want to help you out of, because, we've paid for a lot of insurance on our properties, and we've had so much benefit from. We've had people steal from us. We've had flood damage. We've had all kinds of things go wrong on our properties, and it's all been paid for, and we haven't lost any of our income. So what did that insurance really cost?
That's a good point.
You know what I'm saying? I creatively found ways to finance and get my real estate investing education that has to date made me over $500,000, but the cost of it was $25,000. But I didn't pay any of that out of my own money. But I did invest in that, and I found a way to use.
Yeah, to raise the money.
Right. But I mean, did it really cost me anything if it's led to me changing my life and increasing my revenue? We have a lot of people who work with us on business credit, starting a business and building business lines of credit, and our services cost $2,497. But in as little as sometimes 30 days, people have made all that back in lines of credit. But in 6 months to 12 months, getting $50,000 in lines of credit, I mean, what did it really cost them?
Yeah.
So when you get focused on cost, then what you're not focusing on is gain. You sacrifice gain for cost. And if you make your decisions based off of cost, but you never take into account gain, like what do you gain from investing in your own mind, in your own self, in your own future? Well, your gain, it's like the way the banks look at everything. Do they only look at risk, or do they also look at reward?
Right, absolutely.
Right. So you have to evaluate everything that way. And if you make all your decisions based off of cost, then you're not going to really make any.
I'll save all of you $10,000 in personal development right now. Never let finances dictate your decision. That's $10,000 of coaching right there. Never let any decision you want to make have anything to do with the actual financial expense of it. You know, if it's like, now if it's real estate, we have to look at the numbers. But what I used to do is I would look at something and I'd be like, I can't go on this trip because it costs $4,000, or, you know, that money could be spent for something else. But then it's like, but what is that an investment into my family? Is this an investment, you know? And then so I have to look at it from different things, regardless if I have the funds or not. I'm gonna weigh it. What's the pros and cons on my relationship, on my family, on my health, on my wealth? You know, it's just one of those things. You got to look at all the different factors, not just money.
Well, when we were young, we didn't let the cost of anything stop us. Like if there's something you wanted for Christmas, you know, you ask for it. You know, it's going to require you to work or do something or put some money away. I mean, a lot of us did that, but what about going to college? I mean, whether or not you value college or not, wasn't it just assumed that you're going to go there? It doesn't matter that it costs like $100,000. You weren't like, well, I guess I'm not going to go learn how to be a doctor and save lives then. You know, no, you would be like, no, that's my dream. I'm going to find some. So once you make a decision, you're going to do that. If you decided, oh, I'm going to buy a house, you don't go, well, my goodness, that's $300,000. I don't have $300,000 in my checking account. Ouch. Guess I'm not ever going to get a house. You know, we don't think that way. Once we decide to do something, we do it.
And you bring up a very good point too, because my sister-in-law, you know, what is going on in the world of Ray? My sister-in-law, she's helping her friend find a house. And it's very, very hard because it's a competitive market right now. And she's looking for a house that is under $200,000. Good luck. I mean, house that just put on the market the other day. I mean, there's multiple offers. It's $20,000 more than what we even thought it would sell for. I mean, we're talking, the real estate market is still alive and thriving, and just because there's no inventory. And so, but the way that my wife approached is, my wife is like, oh, don't buy a house right now. What if there's a correction in the market? But that's because my wife looks at it from the fact of how can this be a profitable venture? But that's not what's always right for another person. What's right for her is she's looking for a house that she's going to live in the next 50 years, never move. It's close to her job and it's close to her family, and she doesn't ever want to have to worry about moving. So in that situation, you can't ever really overpay because you're paying whatever the current market rate is. Let's say in 5 years, the market crashes. She actually hasn't lost any money until she actually sells. So it's one of these things you got to think about. Your situation is always unique. And in that case, you know, if she wants to pay $200,000 for a house that may be worth only $150,000 in 5 years, did she actually lose anything? She didn't, because she made an investment into her life and her peace of mind and into her future, instead of waiting 5 years until that market crashed. And then, but why give up 5 years of your life? Sorry, that was a whole nother little rabbit hole I'd like to take you guys on. So But I think it's important to understand that each situation is so unique that it just depends.
I agree. I think that, but I mean, back to the main thrust of things, people get so caught up on cost,
Mm-hmm.
and they don't ever think of gain, or they, risk. Oh, this is so risky. Well, what's the reward? And then only your risk tolerance level. But I just want to encourage everybody that don't, like Ray said, don't let money get in the way of letting you do your dreams. Because if you really are passionate about something, like for me, like when I decided I wanted to marry my wife, right? Well, I didn't have a job at the time. I was still in school, right? So I wanted to finish my degree, get a job, right? I didn't have a house. I was still living with my parents, But I mean, for me to become the person I wanted to become, I changed a lot of things, but I didn't think to myself, well, it's going to cost too much I was happy to make all those changes and what was the, cost benefit, right? Well, I get Emily as my wife, So, I mean, we make those decisions all the time. So anyway, I think we've thoroughly made that point.
Actually, I want to thank Sarky for even bringing that up. I just want to thank you because it's nothing like you said. You're like, I don't want to mean any disrespect or anything like that. Absolutely not. I think that was really powerful. I think that because you and I and Joseph are building this relationship, I think that there's somebody that we haven't even started to converse with that heard that, and it may have just saved their life. So I don't believe that anything actually could be used. Anything like this can only be really beneficial to some degree. Whether somebody gets mad at me or not, I think ultimately it will help them come to an understanding that's going to save them time, stress, headache, and money. Yeah,
I agree.
So thank you guys. Thank you all for being here tonight. Thank you.
Absolutely. So here I am. I'm the chef, right? And we're going to be making our credit banking souffle today. I'm thinking of the Swedish chef from Muppets. I start throwing some things around. But for the folks that are participating in our mastermind, we cover it each and every week. What are the 3 ingredients that are necessary for us to even be able to do credit banking? Let's get some folks reviewing this stuff and throw it out there. Let us know how do we even know? Some people might be on this line for the first time and they're like, I don't even know if I can do this. How do I know that this works for me? So who do we have in the mastermind today? We have Raul saying cash flow. Okay, that's one of them. So let's go ahead and put that in there. So we're going to want positive cash flow. So that's defined as the fact that we have monthly income that comes in, and that monthly income is greater than our expenses, right? So if you're somebody who's like, wait a minute, my expenses are more than my income, well, then credit banking isn't something that you can do right now. But once we learn how to increase that income and at the same time decrease your expenses, we can find a way to increase that positive cash flow.
Snarky says we need some debt.
Absolutely. Debt. It's the number one thing. Anybody have debt?
Yeah.
Anybody have any debt they want to get rid of? All right, let's see what else we have here. So we have positive cash flow, debt, and what is the final component needed to make this? Yes, Raul got it. Line of credit, or in some cases, a credit card. Right, so if we have these 3 things, we have the necessary ingredients to begin doing a credit banking strategy. Credit banking as a system of taking lines of credit and applying that towards large loans that have been amortized with the interest heavily front loaded. What we're going to do with our credit, with our lines of credit, is it's sort of like taking little bite-sized pieces. Like how do you eat an elephant? One bite at a time. right? So we're going to take our credit banking strategy and we're going to convert as much of this highly amortized interest and convert it into cheaper, more inexpensive, simple interest with a fixed APR on our lines of credit. And we're just going to push all of our income and expenses through our line of credit, which will wipe that debt down in a very short period of time. And then we just wash, rinse, and repeat. We just do it over and over and over again. And what that does is, I mean, the whole mathematical side of it is we're decreasing the total number of payments that need to be made on that loan. And when you decrease the number of payments, you decrease the total amount that you have to pay in interest, right? Because what we're doing is we're attacking that principal balance, right? It's wonderful. So we're going to show it to you here. So when we begin to look at expenses or budget, right? Budget is simply your income and expenses. We say simply, right? But many of us, it's not that simple. I know, but that's where we talk about budget. And then we have to look at lines. So this would be a line. And then we start looking at all of our loans, right? Here we have a 4-family unit building that cost $753,000. He also, he or she, I don't know. We don't see when you participate in this in the case study, we don't share any of the information. So once the other tenants, so this is a strategy, I guess, where somebody bought a quad or a fourplex, and they may or may not be living in one unit, and they're going to rent out the other ones. So once the other tenants come in, then they're going to up their cash flow by $5,000. Excellent strategy. Are you proud of them, Mr. Property Guy?
Absolutely, yes, I really am.
All right, so a couple of things we want to identify when we're doing this is well, what is the number one thing when we're looking at the budget? I'll put it out to you. What are we trying? The answer's already on your screen if you can find it. But when we look at the budget, we're looking at the income and the expenses. What are we trying to determine here? Anyone? Bueller? Absolutely. Thank you, Raul. We're trying to establish what is our cash flow. So let's go ahead and put in cash flow. And cash flow is defined as everything that's left over after we have, so we take our income and we minus our expenses, and anything left over is our cash flow. So we have $9,900 in income and we have $8,000 in expenses. So as Raul, once again, coming in with the right answer, we have $1,900 in cash flow. All right, that's good cash flow right there. So now we've identified cash flow. So that's one ingredient here. So, I should put the check mark boxes in here next time so we could ding, check it off. But we've got our positive cash flow, right? So this is good stuff. So all right, positive cash flow is done. Now, do we have any, let's look at item number 2. Do we have any debt?
Ooh, I got an update on the number for you. 42,000 of debt at 23%.
How do you have an update?
I just got an update.
I'm working with Ray. He you would be horrible in a lineup, right? When there's the dark room and someone's trying to point out who the criminal is, you'd be the person coming in and flip the light switch on. Like, oh, I'm sorry. Didn't mean to unmask the person.
I did no unmasking.
All right. So we're looking at debt. So we have $753,000 of debt that's in a loan. There's $26,000 of student loan. So I would say, yes, we have fulfilled the requirement of debt. Faux show. All right. So we have a question in the mastermind from Fritz. Do you need a certain percentage of cash flow? No, that's a good question. You just need it to be positive. So it's sort of like uh, it's the speed at which you're going to pay down your debt. So how much pressure are you going to put on the gas pedal? Or think about water. If you really want to, you're thirsty and you want a glass of water, but you turn the nozzle so it just drips out, right? That's like you have $100 of cash flow. Well, it's going to take a while to fill up that glass of water for you to drink from, right? So the greater you increase the cash flow, the greater the speed at which you will pay down your debts.
I retract my previous statement. I totally was getting two different cases mixed up. This case is, there is no debt on this case.
Thank you.
Just to, I have to keep you on your toes. If I don't keep you on your toes, then life would be boring.
Everybody should have a Ray Fleming in their life. That's all I have to say to that. Okay, so we have debt, and then last we're looking for the lines of credit. Well, we have $82,000 available here in a line of credit with a 0% balance. So I would go ahead and say right here that yes, check marking off all the boxes. So we have positive cash flow, we have debt, and we have lines of credit. So we've identified our cash flow. Let's go ahead and look at our lines of credit. So we're always interested. It helps us make a good idea. We need to understand basically what our utilization rate is, right? We were talking about how your credit score is calculated. What's important here with utilization is this is going to determine how much of that line of credit that we can use when we are trying to implement the credit banking strategy. So here we have $82,000 of available credit and we're carrying a zero balance. So that's pretty simple. I don't even need to break out the calculator or ask Raul, right? I know this one. I can tell you right now that we're at a 0% utilization rate. Now, that means that here's what we need to do. If we only can use between for what we're attempting to do here, what would be considered 30% utilization?
Ooh, yes. So what is 30%?
What's 30% utilization of an $82,000 available line of credit? So then we come down here and we would put, let's see, who is playing the game? $24,600.
Excellent.
Did you double check his work?
I did not. I just assumed Raul was correct.
All right. Well, if the numbers don't work, remember we already have that disclaimer that's out there, right? So we don't want to have any problems with this line of credit. We should really stay below $24,600 in our line of credit. Now, 50% utilization, right? Because if we want, sometimes we really need to just work hard on stuff, and we just can't let this get in the way. So we really can work with up to 41,000, right? Because between 31% and 50%, the credit people are like, meh. But it depends on what we're trying to do. If we want to pay things off quickly, we might utilize more of our credit. But if we're interested in growing that line of credit to get access to more, we might want to stay under 30. So this is why we look at utilization, so that we can understand where we're at and what we need to do. So 0% is good. We have a lot of options here. So here's our debt, 30-year mortgage here at, let's see here. We have, that started February of this year. So this is actually, we're only, 3 months into it? All right. So this is where we're at. So since we're three into it, we're at 257 months left to pay on this loan. Okay. Well, now what we want to look at is what is the debt efficiency? Debt efficiency. This is stuff that we cover when we go over it. Debt efficiency. This is what how we know what should we pay off first. This is a ratio that we look at is how much of our money, how much of our cash flow, or not even our cash flow, how much of our budget are we allocating towards individual debts. So debt efficiency is when you take the balance of a loan and you divide it by its monthly payment, right? So we want to take this and divide it by 4,896. And that equals, and I think I saw, I'm guessing Raul, 153.7. Let's see if he's right. Let's see if he's right. All right, winner, winner, chicken dinner. That is a ratio. Perfect. So let us, so the debt efficiency up here is 153.8. 153.8. That's rounded. Obviously, it was 7 point something. Student loan. Well, we don't know what they're paying on their student loan. And up here on this line of credit, we don't know what the interest rate is. So when that's not provided, we just go with the average. So we'll go up here and say that that's, again, I don't know if that's the interest rate, but that's the interest rate we'll go with. But what is the student loan payment?
Monthly payment, right? So that's what, and interest rate. We got to look at that.
All right, we don't know anything about
Right.
that. Hey, but you know what? When we don't have the information, we just make it up here. Okay, so let's say that they're paying, let's say it's an interest rate of 9%. I don't know, making it up. Oops, 9%. Let's say that,
Probably like what, 300 somewhere?
let's say that their payment is, I want to say 200, just for fun. Okay? $200 per month. Let us find out what is our debt efficiency. What is the debt efficiency going to be? If you're paying attention, if you're following along, right? You take your balance and you divide it by your monthly payment. So our debt efficiency here is going to be 130. All right. Debt efficiency of 130. Perfect. Okay. So what do these two numbers mean? Well, that one's higher than that one. So does that mean we do that one first? Debt efficiency is how do we look at the loan? Well, that's a lot of money right there, and that payment's pretty high, so maybe we want to pay that one off first. And then we look over here. Here's $26,000. That's not as much as that, but that payment is only $200 a month. Well, when you look at debt efficiency, what is it telling us? Let's see what we come in. So Raul says you pay off the lowest first, right? Because the lower the number, the less efficient it is. The higher the number, the more efficient it is. Plus, when you think about it, if you could knock this 26,000 off really quick, you could increase your cash flow, right?
Mm-hmm.
So let's go ahead and do that. So how would we do that? So if we have $26,000 that needs to be paid off, right? The debt is $26,000. Okay. Sorry, let's go ahead and switch that back to black. So our debt's $26,000 and our cash flow is $1,900. Well, that means every month that we make our payment, if we apply our cash flow to it, it'd be $1,900. Oops, not 1,900. $1,900 a month, which would be, the answer will be given to us in total number of months that it takes to pay that off. And Raul says 13.68. And that's what my computer says. But there is no such thing as 13.68 months. So we must round that up to 14 months. So using the cash flow that we have here, and here's what's interesting. So people, they say this all the time. Well, why don't I just take why are you having me use a line of credit? Why don't I just take my cash flow and put it right into the debt?
Right.
It's all about the movement of money and creating the multiple payment experiences. But when you convert when you take all of your income and you push it to your lines of credit, you're converting it into available credit. And all you're simply doing is using a 21%, remember this is APR, an annual percentage rate. And you're renting somebody else's money, leveraging OPM to pay off your debt. While at the same time, with your available credit, you're converting your cash flow, your income into available credit. So it leaves, you have liquidity. When you put all of your cash into paying down a loan, the buying power of that's gone. You don't have access to that anymore. So with an APR, what does that actually cost you? Well, your APR is simply, you take your 0.21 and you divide that by how many months there are in a year. Oops. And what do we get? Not a V. What do we get? It's 1.75%. So if we were to convert that into a percentage, what would that be? That would be 1.75%. That's how much it actually costs to use other people's money to pay off your debt every month.
Super cheap.
Absolutely. So this is something that when people, they look at that and they're like, well, wait a minute. You go down here, this loan's only 3.75%. And they look at this credit card, they're like, oh, it's 21%. I don't want to touch that. Actually, you have a better interest rate, a monthly interest rate on this line of credit than you do even on this loan over here, don't you? So what do we have over here? Yes. Good job. So here's what we're looking at. We pay off this. We pay this off. What happens to the $200 monthly payment?
That goes to the cash flow.
Thank you, Raul. I mean, thank you. Right. So what that means is our expenses are going to go down by 200, right? And that means that our cash flow is going to increase, right, by 200. Great. Let's see what we got going on here. Perfect. Raul, good job. So now when we go to start applying everything to this loan amount, it's going to be totally awesome. Okay, so I'm going to whip out now my handy dandy HB 10B2 calculator. Everybody should have one, especially if you're going to do anything involved with
real estate loans,
money, notes, right? Okay, just want to understand how mortgages work. So put that in there. I'm just putting all the information in here. Helps me calculate where we're at. We're at a 3.375% interest rate, and the total mortgaged amount is $753,000. Right? Plugging all that in there. And so one of the things that I like to put in here is you have your principal and interest payment. What's that going to be? Oops. No, that's pi. That's not what I was looking for. what I wanted to show you was that the actual just principal and interest on the loan is $3,328.98. But this payment says 4,000. Oh my goodness. So if we subtract out what we're paying here on this loan, what do we get? This means that there is where's all this extra money, Ray, coming from? Why do I have to spend $1,567.02 more on this mortgage when it should only be costing me $3,328.98?
Typically taxes and insurance, and then depending on what type of loan, mortgage insurance as well.
Mm-hmm. So there's PI, and then you have what's called TI, right?
Right.
And that, and this number over here is your taxes and your insurance. So sometimes when people, they sign their paperwork and they're running their numbers, they're like, okay, well, my mortgage payment's only going to be $3,328. And then all of a sudden when they get down to signing their paperwork and they find out, wait a minute, what's this $4,896 payment? Well, because everyone has to pay taxes and insurance.
Mm-hmm.
So if you're borrowing somebody else's money, they're going to want to make sure that that's insured, right?
Yep.
Okay, so now that we understand everything, when we go to put this into our handy dandy credit banking calculator, I just wanted you to understand why our numbers are what they are. Okie dokie, okie dokie. So here I am plugging in the numbers. We are going to see how long it's going to take to pay this thing off. Now it's $753,000 for the mortgage, but we have paid 3 months on this. So let's put in the new amount. So this is good news. 3 months has really brought this down. So we're at $608,534.94 at 3.38% interest.
There's got to be
257.
There's got to be some miscalculations.
Nope. This is the
so 150,000 in 3 months.
Oh, see, I put 257. Look at that. I actually accelerated. I paid off several years for you.
Oh, you know what it is? It's 360. That would be 357.
Right.
Samsonite. That was way off.
Hold on. 357. Let's go ahead and
the Magnum.
All right. $749,356.26. All right.
Perfect.
Now that looks right. We're using 21% here.
Are we sharing our credit banking calculator? Let's see.
Am I sharing
Nope,
everything?
Can't see it.
Oh, Ray, you have one job here. It's simple, but all your job was to share my entire screen with everybody.
Beautiful.
Okay. Everybody should be able to see.
All right, let's show them where we entered in this information.
Hold on, I'm not finished entering it in. Income, and then we're at expenses, 7800. All right. So what we entered in here was we entered the loan balance, the interest rate, and the term. And remember, I knocked 100 accidentally. I knocked 100 months off of that. My bad. Now, our payment comes to $3,331. So we look here, 3,000. So we're very close. There's just probably
A rounding error.
exactly, a rounding error, but close enough for the purposes that we want to discuss here. So we have everything we need here that we're looking at. So let's look. So over the next 29 and 3/4 years, you will pay off this loan if you just make all the minimum payments, and you'll pay that 750 what was it, $3,000 back, plus $439,821 of interest. So the blue column is if we just do nothing. The orange column you see here is what if we made an extra $500 every month and put it towards the principal? Well, look at that. It shaves right off the bat 6 years.
Nice.
6 years just by making that extra $500 payment. And then we use this credit banking strategy where we put the cash flow of $2,100, right? And look, here's where it comes in at. It pays this off in 15 and a half years, saving you over $239,000. This is just doing what we were talking about, pushing all of your income through your lines of credit. Over 15 and a half years, you're going to be growing these lines of credit as well. And it's going to be boosting your credit score. It's obviously lowering your income to debt ratio, helping you get approval on more banking products.
If you go back to the previous screen, because it looks like that this project isn't being rented out yet, right? Because it says once tenants start paying, then the cash flow will go to 5,000.
Right. So if that were the case, let's say it gets fully rented out this month. All right. So we put in an extra 5,000 in here. All right. Put an extra 5,000. Boom.
Wow.
This thing's paid off in 8 years. 8 years and 1 month. Now, that's just using this basic line of credit method. I want you to keep in mind that there are two factors that this model doesn't take into account. It's basically saying that your income is going to remain consistent. It's not going to change at all over 30 years or 23 years or 8 years or even 6 years here. But we know that's not true. Our income fluctuates. And it also, this model doesn't take into account that your expenses change. Your expenses go up, they go down. And so what this is a mathematical representation of is if your income were to hold steady and if your expenses were to hold steady, this is what you could expect to happen utilizing a credit banking strategy. What's important if you're going to use this calculator, as many have, is to constantly update this calculator as your financial numbers change. If your income changes, if your expenses change, then you update this calculator. But then everybody always asks, well, what about the yellow column here? What's this advanced credit banking? We don't actually cover in great detail advanced credit banking strategies in this mastermind, but this basically what this is saying is, as you're paying down the mortgage on this property, once you get 40% more or more of equity in the property, you could apply for a first position home equity line of credit through a say a credit union or a regional bank. And even today, we were learning, if you were on our we do a weekly training on business credit financing, but we were looking at peer-to-peer lending that we're offering some very attractive lines of credit as well. So with that being said, these lines of credit come at very attractive rates. So as you begin using a basic credit banking strategy method, part of the way through, you can accelerate it with, say, a home equity line of credit. what we recommend is a first position home equity line of credit that completely wipes out the mortgage. And then once you pay off a loan, it's gone. You'd have to reapply to get another loan. But once you convert everything into a line of credit, you can pay it down, you can put more on there. It's revolving. It can go up and down, and you're only ever paying on whatever the average daily balance is, or the balance at the end of the billing cycle. So this is very useful to, once you've paid off your house, to also have the ability to access anywhere from 70% to maybe even as much as 90% loan to value with your property. We don't cover the advanced credit banking strategy here on this mastermind because there is so much that goes into this. This would be its own mastermind. We also use, like we were talking about with peer-to-peer lending, we utilize a lot of business strategies to create business type HELOCs or business HELOs, where your business can loan to you on the personal side. And so there's a right way and a wrong way to do all of that. And again, you want to always check with competent legal professionals before you ever implement any of these strategies. But as you can see here, this is an amazing strategy. Look at, I mean, you're saving over $276,000 in interest if you just stuck with the basic method.
I just did the math on that. That is an income. If you look at it from an income perspective, since you're saving the money saved is money earned in the years of getting your loan paid off, that would be the equivalent of adding or making $34,000 a year by just implementing that strategy. That's insane.
And then they might come up to a period of time where all of a sudden then, because you just adjust what the balance is, right? The months left to pay. And you're always, I mean, maybe your interest rate goes down. Maybe your income fluctuates, and you just always plugging in your numbers to see where you're saving. All right. Well, folks, we have literally reached the end of our time here with you today. Sorry we got started a little bit late, but hopefully we made up for it and gave you some amazing information here to go over. Before we leave, is there anything else that you had any questions on? Anything that we could quickly before we go answer for you?
We had some folks wondering how to get the calculator.
Oh, that's a great question. You have to join the mastermind. Join the mastermind. Let's go back to there.
First, you got to hit the thumbs up button on YouTube if you're on YouTube right now.
Right. You put your right foot in, put your right foot out. You do the hokey pokey, turn yourself around. All right. Oh, I went back too far. This is all of the stuff that you covered today.
We're getting there.
This is good stuff. You guys got to make sure you come here on Thursday night and see how Wise Guys and Ties utilizes this amazing strategy for investing in real estate. So you want to get the credit banking calculator? Well, you got to be a part of the mastermind, right? How do you get to be a part of mastermind? You go to wiseguysandties.com, right? /credit-banking.
We're seeing that screen, just so you know.
Oh, perfect. I love showing you screen number 1 when I want to show you screen number 2. There, that should make it a little bit bigger on your screen now where you can see that. All right. So what you do is you go to wiseguysandties.com /credit-banking. And then on Tuesday nights, you're going to be put into the system where you can, where you definitely get invited to all these webinars. And there's a text reminder or an email reminder that goes out. But you put your first name, your email, your phone number. You have to check mark these boxes where you hold us harmless for anything that happens, right? And then if you want to participate on the and have us go over your numbers, right? You just share it here. Now, we don't give out any of your information. We don't sell any of your information. We don't even communicate with you unless you want us to. So put your information in here. If you want to have a one-on-one 30-minute free consultation, you just let us know. put your any information. So this basically gives us the idea of what your income, expenses, available credit, current balance on your credit card interest rate. Go ahead and if you have one loan, put it in here that you want to pay off. And then we talk about your current situation. If you have more loans, if you have more expenses, if you have more lines of credit, if there's anything else that you want to include that we can put into the situation, we will do so. All right. I had a question come in from Fritz saying, how can I use credit card if I don't have enough equity? If I understood what you mean when you said equity, that would be like if you're running a high limit, like a high balance, so there's not a lot of available credit in there. We're just going to push everything through the lines of credit, pay it down. I think that the equity part of that question throws me off.
Are you talking about like if you don't have enough equity in your house, how can you use a credit card?
Well, you use the credit card in the credit banking strategy to create, create the equity. How can I use the credit card if I don't have enough equity? I'm sorry that the question just confused me just a bit, but if you mean if there's not enough equity in the card itself, then we're going to pay down that card, pushing all of our income and our expenses through the line of credit, and our cash flow is the speed at which that line of credit will be paid down. So if we're talking about the mortgage, what we're doing is we're taking the line of credit and then we're making principal only payments, a large chunk. It's called chunking, where if you have, say, a $20,000 line of credit, we might take a $10,000 or $12,000 chunk principal only payment out of the mortgage. And then with that balance, we'll sweep it down utilizing our income and our debt to pay that down. You really want to make sure that you're here each and every week because we show you that strategy. So we just finished actually showing that strategy in Credit Banking Mastermind number 20 that we went over. We actually showed how to do that. So if you missed any of these previous masterminds, go back and watch the other ones. We will get to answering that specific question probably 4 masterminds from now, where we will cover your specific question about how we're actually paying the mortgage. But you don't have to wait 4 weeks to get that information, right? You can go and watch our previous Credit Banking Mastermind number 20, and then they'll see how to do that, right? Great questions. All right, folks. Thank you so much for being here. God bless you each and every week. You guys come out here. We hope you're getting a lot of value out of this. And if you are, really like and subscribe if you haven't, or put a comment or two below. Really, let's thank the Velocity channel for having us out here tonight. We're super grateful to CJ Wallace for having us here each and every night. What we want you to do is like and subscribe if you find value here, because this is how you tell YouTube that this content is good and we want more of it. And so this will push this out and we can reach more people and we can grow our mastermind and we have more minds working together. This is going to be great. If you want to work with the Wise Guys and Ties, you want to reach out to us and contact us, find out more about some of the different systems that we use, business credit, real estate investing education, how to invest in real estate, masterminds on all of that, reach out to us. You've got our phone number, email, go to our website to register for any of our upcoming events. This Thursday at noon, we're going to be covering business credit. Right? It's very critical in growing and building lines of credit for your business.
Or two, we changed it. 2 Pacific time?
What did I say?
Noon. It was noon. We rescheduled.
Okay. It is 2 p.m. Pacific time, right? Thank you for that. And then at 6 p.m. Pacific time, you're running credit banking, or not, you're running real estate mastermind number 3.
Yes.
What are we covering?
Ooh, that's exciting. You're just going to have to show up to find out. We're going to be talking about how to get into real estate investing, building business without using any of your money or credit.
I thought you were going to go over that whole how to evaluate a property kind of thing.
That could be, yeah, we will be doing some of that too.
All right, that's cool.
We're going to be doing some evaluations. We're going to do some hands-on real life scenarios. We got all sorts of stuff. We will be doing a little bit of negotiating on rehabbing, and we got a lot of good, exciting stuff for you.
Perfect. Folks, we're super excited. We thank you so much for all of your support, for being a part of us. We want you to know that we're here to really help you. It's really our purpose, our mission is to help you do whatever God put you here on this earth to do. And so we want to give you the resources and the tools to help you build and grow your dreams and achieve the success that you're looking for. And so we look forward to helping you. Make sure you like and subscribe. Thank you so much. Myself, Joseph Smith, Ray Fleming.
Good night, everybody.
God bless you.